Research shows that investors underperform the market by 3 to 4% each year. That's half of the market returns. And this is due to investment biases and mistakes that most investors make. In this episode, we talk about the 4 most common investment mistakes and biases that prevent investors from getting good returns. And we talk about how to prevent them. To help me with this, I have invited Thomas Laureys. Thomas is a finance writer who writes about investing and behavioral finance for big organizations like the VFB and a lot of big finance newspapers in Belgium. He has read more books on investing and personal finance than anyone I know. And Thomas is one of my favorite writers on LinkedIn, where you'll find him very active. If you are an individual investor or if you're learning to become one, then this episode is for you. We're going to talk about investment mistakes, behavioral biases, and things that prevent us from performing well and having good investment returns. And the good news to all it is, you will see towards the end of the episode, is that one of the solutions to this is to learn to invest passively with index funds for the long term. And that is exactly what I teach. And if you want to learn more about index investing, how to get started, what are the steps to take so that you actually get started without making the beginner's mistake, then I highly encourage you to check out the free investing workshop that I have on the website, which basically teaches people how to build wealth on autopilot, evidence-based investing, optimized for taxes in Belgium. So that's available on the website. It's firebelgium.com/investing workshop. It's free. And so I recommend it to everyone. All right, let's get started with the interview with Thomas. Let's go. Hi, Thomas. Thanks for being here today with us. I have a really important question to ask you, one that is, important for all investors. And that is, what are the main mistakes that investors make?
Well, first of all, thank you for having me. And it's maybe not the most fun answer to hear for investors, but there's many thousands of mistakes we make and many thousands of biases and ways we think incorrectly about stuff. But I've decided to focus on 3 big ones because, first of all, they're very relatable to a lot of people. I think everybody's making them, including myself, all the time. And they're all linked by one thing, and it is that we often overestimate ourselves a bit. And it's also interesting, some of the best investors, if you want to know who the best investors are, those are the ones who are not afraid to talk about their mistakes. For example, Warren Buffett, best investor ever, everybody agrees, but he's always laughing at himself, cracking jokes about the stupid things he does. So if you want a good investment advisor, always go for someone who is not shy to talk about his mistakes. And the 3 big ones that I've noted down for this one: overconfidence bias, self-attribution bias, and illusion of control bias.
Yeah, and so these are basically aspects of overconfidence, right?
Yep.
And it's true that from most, I would say overconfidence seems to be the trait of some investors, but I also see a lot of people who come to me specifically saying, well, I don't know how to invest. So would you say that this is something that we see more in established investors, also in beginner investors?
I think everybody's got that problem to a certain degree. It's really fascinating, the overconfidence bias, because you can see it in every aspect of life, For example, if you ask a bunch of students who here is better than the average student, in those studies you see that 80% of people think they're better than average. Now, if you know something about statistics, 80% of people cannot be better than average. And you see it in the weirdest things, in driving and stuff. One friend once sent me a study, and it showed that, for example, French people think they are the best lovers in the world and way above average. So you couldn't think of the craziest field in the world and people aren't overconfident. Now, it is true in some ways. It's not bad to have a little bit of overconfidence, because otherwise we wouldn't do anything, We wouldn't start a business. We wouldn't try to date somebody if we think, oh, she's so gorgeous. You need a bit of overconfidence to say, like, I'll just go for it, And that's not bad. But in the markets, it's a bit different, because in the markets, you're not facing someone or one challenge. You're literally taking on the whole market. That's millions of people who are all trying to do better than each other. And you'll just get punished. It's difficult for one person to constantly do better than millions of persons, and it might work once or twice, but in the end, the market will punish that kind of overconfidence. And the fact is that the funny thing is, most people also don't really realize this one, and it's really hard to get people to understand it because I always give this example. It was in this paper about a guy writing about behavioral finance, and he had spent all his day teaching professional investors about behavioral finance. So a whole day long, look, watch out for overconfidence, watch out for these kind of mistakes, be aware of this. And at the end of the day, he says, I'll see what they've learned. And he does a little test and asks everybody how well they rate themselves as investors. And I think in the end, like 70 or 80% thought they were still better than average after hearing all day long
Yeah.
that there's something like overconfidence. And the most beautiful part about it, and I find it such a brilliant quote, he opened the letters because they all got to write this in a little paper. And one of the guys wrote, I know everybody thinks they're above average, but I am. So it is true. It's a real difficult one because even if you know it, we all suffer from that in some way. I think everybody, if you look at home, everybody's got some project they can say, oh, I was overconfident. For example, people who are remodeling their homes will often know that you start like, I can do this. And after you find out it's not that easy, hobby, sports, you've got all these kinds of examples where we think like, oh, it's going to be easy, I'll just do it. But it's such a difficult one to overcome, and I think everybody struggles with it. And that's why I like the story, evil professional investors who do this every day, who have just spent an entire day being pointed out, you might be overconfident, still have a hard time realizing it. So it is true, it's also a bit of a balance, like you say, starting investors sometimes need to have that bit of confidence, because if you don't have a bit of overconfidence, you'll be like, oh, it seems too hard, I'll never be able to do it. But what you see next is often with investors, first they have a bit of luck. Like for example, oh, they buy a stock, they do better than the market for a bit, and they're like, I'm the biggest investing genius ever. But after a while, you will probably notice that with people who take your courses and so, after a while they notice it's not that easy. So it's certainly not only beginning investors, even the most professional investors have these kind of problems. So that's why it's such an important one.
Yeah, I mean, just talking to you now, I realize how wide and important this topic is because as we are saying, for people to get started, most of them don't because they lack confidence and
Yeah.
knowledge and feel like they have to rely on someone else, or they just go to the bank because they're like, ah, it's way too complicated. What I teach is I tell people, well, it's not as complicated. All you need to know is like a few basic principles and then you can get started.
Mm-hmm.
But then the problem is when, well, and I teach in a way where we're not stock picking, obviously, as you know. But as people get into investing, then overconfidence comes over because of
Yeah.
all of our biases, right? And the way our psychology is built is we are meant to learn and to improve and feel better and take action. And in all other areas of life, this is true, right? The more time we
Yeah.
spend doing this, the better we become at it and the more confident we become. And being confident and even overconfident is helpful, right? This is helpful at work, in your career,
Yeah.
in saying like physical fitness, right? The more you know, the more you're confident, the more you exercise, the better you become. And it's kind of a virtuous cycle. But
Yeah.
it's not true in investing.
And often it's interesting because you point out this learning curve. You've got a few models like that who show you. Often someone begins and you're like, oh, I'm not good at this, I'm struggling. And often you see that shooting up. Like it's like the first time you drive a car, it's like, oh, how am I going to do this? And then you've driven the car for an hour, and like, oh, it's not that difficult and I've got this. And then all of a sudden you get into a situation where it's really complicated and you feel like, oh, I might have been overconfident. So often you see it's taking off and then descending a bit. So it is a process that you see in everything you learn. We go to this cycle of being not confident enough to being totally overconfident to getting our feet back on the ground. And you see it with a lot of investors. I've seen many investors, like in 2020, a lot of people started, a lot of the young people. And for VFB, I had a group that I was guiding and setting that up to be an investment club. It was interesting to see in the beginning, everyone was like, oh, a bit scared and this and that. And then people started making moves and so on. And they were all like, oh, we're doing so great and active investing. And look, we've found all kind of ways. And then I think now all of them have stopped being active investors and been like, yeah, we've learned after a while that we cannot do better than markets, so we all became passive investors. So you see that interesting curve. And then you can apply it to anything in life, you know?
That is so interesting. And it might actually be a good way to make people realize how simple index investing can be after they've realized how hard it
Mhm.
is to beat the market with stock picking. So that might be an interesting way of helping people learn about this stuff. I like it. It's giving me
I
ideas.
I often tell people before you really start investing, read a few books and then do it virtually a bit, you know? Set up one of those accounts where you can make virtual trades and so you've got a bunch of fun apps where you can do that. Because it's a good way to learn. You don't take the risk, you're not stressed about it, but you might make those mistakes with no money before you have to really make it with money. I find it's a good way, a playful way to start with these kind of things. And that way, if people have to learn the hard lesson, like stock picking is not for me, they've learned it before they lost money in it. And then they can just say, okay, it's difficult enough if I do it in real life with my real money.
I think that's an interesting way of getting started. I would say as long as the benchmark that the person is using is correct, right? So if the
Mm.
benchmark is, am I doing better than a savings account? Then they might get overconfident because they're like, yeah, I'm doing better than a savings account because I picked 10 stocks and on average, I have
Yeah.
5% gains. But if the benchmark is the markets, then it can be
Mm.
interesting because after, the more time passes, the harder it gets for them to beat the
Yeah.
market.
Yeah, because you've got the same thing with Bogle, I said. I think I said it. He had this thing. Yeah, a lot of people are going to want to play around a bit because it's fun, it's exciting. Everything we learn, we love experimenting as people. It's in our nature, you know.
Mm.
Even if it's things that's not good for us. I mean, for example, look at teenagers. You'll be in that phase too with your children in some time, I believe. They'll start to get in that phase where they want to experiment with everything. You can't stop that. But what I tell people is think of Bogle. He used to say, "Oh, then do it for a little part of your portfolio. You can use as I think he said funny money or silly money. I forgot the term, and just mess around with that. Do some active investing. Do whatever you want, but keep checking back." And I tell people, still feel like oh, this deep down in me, there's an active investor. Do that a little bit for a little bit of money, but every now and then you should check and see if the passive investing is bringing in more money. And I've heard people who actually did it, and then after a few years, like, yeah, I had fun. I learned a lot of stuff and this and that. But then I look at all the time I'm putting in there, and the results are just worse. And that's sometimes I think a better way to convince people. Like, say, a lot of people will resist and say, like, no, I'm not going to go for passive investing full time. I'm going to do some active. But sometimes just put the two next to each other and see, like, oh, wait, the results are not that good. I'm putting in a lot more time. And some people just enjoy playing around a bit with a little bit of money, but then do it on the side. And it's a good way to show people, oh, I'm doing both of them now. Yeah, if this one is really more interesting, then I go for that one.
Yeah.
Because often people just don't want to make that jump and then they can kind of ease into it.
Yeah, that's interesting. That's a really cool approach.
Mm.
Okay, so this is overconfidence, right?
Mhm.
What other big biases and big mistakes do we see?
Well, I always love self-attribution because you see it in every walks of life. Basically, if you would summarize this one, it would be like all good things that happen are thanks to me, all bad things are not. And you often see that with people. For example, I sometimes have that too. My girlfriend always laughs at me in the car because I'm a defensive driver, but when I see other people driving, we like to see, I'm always like, how can nobody drive? These people are morons and that sort of thing, you know? And you start yelling, and you see a lot of people doing that, like, oh, I'm very successful. That's all down to me, you know? And you see the same thing in the market. Like, for example, somebody says the stock is going up. It's like, see, I knew all along. I was brilliant. I get this. And then all of a sudden the market goes down. And it's like, the market doesn't get it. They're all wrong, you know, that sort of stuff. And you see that all the time. And it has to do with everything in success in life, you know. But people always say, all the successes, yeah, but I worked hard, you know, because everybody works hard, but that's down to my work. And the failures and so on, that's down to, oh, my boss sucks. Oh, the economy is bad, that sort of thing.
Yeah, bad luck.
And yeah, indeed, because the fact is, if you read books like, for example, Taleb, who wrote a brilliant book, Fooled by Randomness, and randomness plays such a big such a big role in life, you know? We're dominated by luck, by coincidence, and so on. And we sometimes forget it, and we like to think everything we do is mostly down to our own actions, and everything that goes wrong, yeah, that's not me. That's just the world not getting it. Especially in stocks, you hear like, you know, I was right about the stock. Once I heard a professional investor say it, I was like, this is so funny. It was like, I was talking about his picks for the last year. Said, "Yeah, I still believe my picks were right, and everything that I predicted was right. It just didn't happen that way in the market." It's like that's a fancy word of just saying I'm wrong, but I don't want to admit it. So it's something you see in so many ways,
Mhm.
especially and it doesn't mean that people who are successful should not be proud, but you have to realize that a lot of things you do are coincidence and luck, you know? You see this in all walks of life. Sometimes people come out with an idea, product, and it never works because it just doesn't take off. But then they come out with it at the right time, and suddenly it kind of kicks off, you know? There's a whole bunch of luck and randomness in there. Also, I would like to add, people might think if you say that, like, it's a bit depressing, but actually it's a very positive one. This, and I'll have to give you the name because I don't know the name of the author anymore. He wrote his book. It's a physicist, and he explained how much randomness there is in life and how we keep thinking it's all structure. I think it's The Drunkard's Walk, and he says a lot of people find this depressing and say like, oh, but what? Then why should I try it? But he says it's actually a very positive thing because there's a lot of luck and coincidence that determines our lives, but that also means that the more times you try something, the more chance that you have that you'll get there. You know, he says it's like in baseball,
Mhm.
you need some luck to hit that ball, but if you keep swinging, the more times you keep swinging, you might actually hit. So it's actually kind of a positive message too.
Yeah, yeah, because basically you can create your own luck by
Yeah,
just keep trying, by just
yeah.
keeping trying at luck, and at some point it will turn in your favor.
Yeah, because he gives some brilliant examples in that book. For example, we always think someone is successful, and it's because, you know, that was going to end up anyway like that. You know, they're just that brilliant, they're just that good. And he gives all these examples. For example, some famous authors like Stephen King and J.K. Rowling. And now we think they're such good artists, they would have been successful anyway. And then he writes like all of them got rejected time and time and time again. And then all of a sudden, how should you explain that? There's this randomness, there's this luck, there's someone who said like, this is something and we're going for it. I know, for example, I'm a big Stephen King fan. At one point, he was so tired of it, he even threw his book into the garbage. And his wife said, you should try it again, send it out. And after like, I think 10, 15 times, that author and that publishing house finally said, oh, this is great, we'll try it. And he's one of the best-selling artists of all time now because
Mhm.
someone just saw something and it was the book Carrie and it took off. So we often think also when we look all these things, oh, it was destined to be that someone's going to be successful. No, it's a bit of luck that you need in everything. But if you keep trying, yeah, it's an interesting one. And he gave all these kind of examples of movies of success of even investing and all and how much luck was in there, you know.
Luck and
Even
time.
yeah, and even the calculated it with yeah, he's a physicist, like how big is the chance that by pure luck, an active manager outperforms the market for even a longer while? And actually, it's not totally unheard of and all. So it's a really interesting one. It's
Yeah,
also yeah, a really positive one in a certain way. Just keep trying, you know?
there's this image that obviously circulates amongst index investor of active managers being like if you were to take a monkey and let him throw the dart at
Yeah.
like the stock market and pick a bunch of funds to pick a bunch of stocks and make a fund out of it, the odds of that fund outperforming is as good as any active manager's fund.
They actually did that, you know?
Was that
Uh,
you did that?
the no, actually that was actually done. I think
Oh.
it was the Wall Street Journal who in those days apparently you could still own a monkey and they hired a monkey and if you google it you can find him and they just let them throw dots at the paper where the quotations they kept them on like that a bit. And in Holland you've got a gorilla like that. You should look it up, a gorilla who does stock picks, so they just put the names of stocks on bananas and he picks it and it's been outperformed for a whole while. So it's a brilliant. I love this kind of experiments. They just show you, yeah, it's all a bit relative, you know, because you can't really claim that. It's just a beautiful example. You can't claim that that monkey or that the bigger monkey had some kind of really high work ethic or was so brilliant. It just proves that you needed that bit of luck, and there's so much luck and coincidence in life.
Yeah, it could be that the monkeys was lucky. It could also be that they had 10 monkeys and that out of the 10, one of them did well and they picked
Yeah,
that one for the newspaper. Another way
yeah,
of dealing with
yeah.
this, all of the biases. So we have the first bias, overconfidence. The second bias is self-attribution.
Self-attribution. Yeah.
self-attribution. So this is basically when we believe that the good things we've done are due to our hard work and because we're so smart, but the things that went bad is because of bad luck or some other outside reason. And basically, we don't
Mm.
apply the same logic to positive things and negative things happening to us. And obviously,
Yeah.
as investors, that reinforces bad behavior because we don't learn from our mistakes and we think that we're so smart.
Mm.
So it links back to overconfidence, right? As well. Uh,
Yeah, indeed.
very, very cool. And obviously, to me, this makes sense from an ego survival perspective, right? As human beings, we survive by being aligned with our ego, right? If we feel
Mm.
like we are worth, then we keep doing things that for our own survival. And basically, taking credit for things that we did well is natural, and then rejecting things that like rejecting us being the reason for something going badly is also a survival
Mm.
mechanism. So it
Yeah,
basically that's why it applies in every area of life, and it's
indeed.
quite strong in investing because it affects us negatively, right? Whereas it can probably help us in many parts of other parts of our lives. It doesn't necessarily help us with investing. Very, very cool.
Mm. Yeah, and it also links to the third one, the illusion of control bias. You often see that people think they have a greater impact to control all sorts of things. And sometimes you've got very funny examples of that, like all kinds of rituals. You might see it when you watch football and so on. A lot of footballers, before they go, they've got some kind of ritual, you know, they kiss a cross, they say a little prayer, they have to touch the field in a certain way, because a lot of people believe, oh, that's going to bring me luck, and somehow I can control things. There was even this study, and I found it fascinating, that gamblers who really want to win or are down in the luck are throwing the dice harder because somehow they think that it's going to bring them luck, you know? And you see that kind of illusion of control a lot in investing. You see a lot of people who do a lot of things to try and see how the market is going. They think they can sort of know where it's going. They think they can control it. A lot of people are like, have all sorts of systems in which they decide, oh, now I can invest, then I can't invest, and so on, because they think there's some kind of control, that there's some kind of structure and a pattern to the market, and you, by your actions, can control it. And the thing is, if you know anything about the investing world, it also relates to the luck and the randomness. The market is very random, has all kinds of patterns, but it doesn't repeat and it's not predictable. And that's one of those amazing quotes from Bogle too. Instead of saying "Don't stand there, do something," he always said, "Don't do something, just stand there." You know, and that's the same thing you do with ETF investing. You're not going to be like, "Oh, I can predict everything. I can time the markets. I can step in and out. I can protect myself." You just go for passive investing, and that's it. And you let them kind of go for the ride. You know, and that's what you see with with a lot of people. They try to focus on everything, trying to control the market, sort of, you know, how it moves, what it does. But the fact is, you can't really control what the market does. You should more focus on the few things that you can actually control as an investor. And the few things you can control are your costs, keeping them as low as possible, having a good plan and sticking to them, sticking to your asset allocation. And the most important thing, maybe of all, is controlling your emotions. All the rest, that's kind of out of your hands, you know?
Yeah. So illusion of control. I'm not familiar with the world of stock pickers and active investors,
Mhm.
so I can't really say how that works in there. But I can see how it applies to other parts of our lives, and I can see how it applies to, you know, people behaving on social media, right? Being super worried about stuff that they can't control
Yep.
and not doing anything about the stuff they can actually control, right? I think there's a whole area of personal well-being that relates to this is when you focus too much on stuff that's external where on which you can't do anything, and then you don't do anything about the stuff you actually control, and that has a real
Yeah.
impact on your life.
And now that you say it, it sometimes also works in the other way. Like a lot of people are angry at politicians and that sort of thing, and they're like, they should fix this and they should fix that and so on. But the fact is that one person who sits there, and for example, if you elect someone to run the economy, it's not like he has a big desk full of buttons that says economy goes up, goes down. Those people try to make all sorts of choices and reassure people, but the fact is, nobody can control the world anymore. It's gotten so complex and so difficult. There's so many things. The most thing, if you look at it, even a US president, if you look, he doesn't have any control of the economy. The only thing he can really do, if you think about it, is trying to say, come, we're going to do some things. I'm not sure if it's going to work, but I'm going to say it in a reassuring way, trying to convince people. And that will convince the economy, convince the way that we think. But it's not more than that. Even the people with the most power in the world has gotten so complicated. It's not like they can push on one button and it's done. You know, they can only say we're going to try to take measures. They can only try to calm people and make them believe that things are going to go for the best, and then it will be sort of a self-fulfilling prophecy. But people seem to really think like people in politics. They just push one button and everything's fixed. The economy goes up and down.
I
My
wish.
wage goes up and down. But the fact is, yeah, the amount of control they have is so limited, you know. And we sometimes have that impression. It's like some people can fix everything, and that's just an illusion, of course.
Yeah. So the illusion of control here, it applies in all areas of life. I guess, these biases that we're talking about, these
Yep.
behavioral aspects of our lives, it applies in every area of our lives. And then it applies to our personal finances and investing as well. I love this one
Mm-hmm.
here. Obviously, illusion of control is the way we invest and the way I invest and the way I teach it is we
Mm-hmm.
focus on what we can control and
Mm-hmm.
then we let go of what we can't. And what we can't control is what's going to happen with the market. What we can
Yeah.
control is, how well diversified we are, how complex of a portfolio we have. So obviously, we want to maximize diversification. We want to have a very simple portfolio because it's easier to manage with fewer mistakes. We minimize costs. We minimize taxes because we can control that. We build a good personal investment plan, just like you said, with the good asset allocation, and then we manage our emotions. And the easiest way of managing emotions is just not being involved at all. So having an investment that's as automated and as long term as possible with a strategy that works in whether the markets are going up or even if
Yep.
there's a market crash, we are ready for it at any point. So this aligns perfectly with our way of thinking. And so I love this example of illusion of control bias because it's exactly like basically what I teach is a solution to that, right? It's exactly aligned to that. So
Yeah.
certainly it aligns really well.
And that
um
is what is also beautiful, like you say, we live in an extremely complex world. Investing can be extremely complex, but one of the best ways to deal with that is simplicity, making things as simple and easy as possible, because those are options we can keep up. How more complicated you make something, how more difficult it gets to keep that up and keep working that way. So one of the beautiful things I think about investing, about passive investing, about behavioral finance is you see that the world is extremely complicated, but simplicity is often the best answer to everything.
yeah, absolutely. I mean, that's also my philosophy. I want to talk about how investors can actually we already started touching on this, but
Mhm.
if can we do anything to help us manage those behavioral biases that we have? How do investors go about not making those mistakes and not falling for those traps that seem to be so common and so prevalent in every area of our lives? So how do we deal with that for investments?
Yeah, it's indeed a difficult one. And I find it's always an interesting one because sometimes behavioral finance is a bit like I'll tell you what to do and I'll tell you what everything that's wrong, but there's no solutions. That's sometimes something that people throw at the behavioral finance. Which is a bit infuriating because they fill books and books with everything that you're doing wrong, but how can you fix it, of course? The first step, of course, is getting to know these things, reading about them, just knowing that these mistakes exist, you know, that's the first step to realizing they're there. You need to know that, but it's indeed often not enough because how shall we say this? We will often think these are mistakes that other people make and not me. The old overconfidence coming back, and we see with a lot of things. I mean, if you look in life, there's so many things we know we shouldn't do. If it's smoking, if it's speeding, drinking, drugs, everybody knows these things are bad and we should probably not do them. And once I gave a lecture and I was like, everybody here, put up your hands. Who knows these things are bad? Everybody puts up their hands. Now, who of you has never done these things or isn't doing these things? And nobody put up their hand. So we should also, and that's what I'm saying, nobody's perfectly rational. I think there was a study like 80 or 90% of our decisions are irrational. That will always be the fact, but we have to try and perfect the little parts. So the first thing is of course gathering knowledge, reading about it, trying to know what these things are so you can start recognizing them. That is often not enough because yeah, it's not just because you know something is bad that you'll be able to stop it. And it's interesting because a lot of the behavioral finance founders and researchers also started funds who also didn't do well because it turns out that they were either also making some of these mistakes themselves because they're human, or it's really difficult to capture these mistakes and kind of make money out of them. The second one I'd say is repeat, repeat, repeat. The fact is just keep reading about these kind of things every now and then, you know. You've got like also like in visual capitalists and so they've got beautiful visuals about that. Hang one of those above your desk when you're making your investment decisions. Keep reminding yourself, you know, all the time. That's just keep thinking about it. What's also a good one, and that a lot of people do, is documenting your mistakes, you know? Because what we often do is we see, oh, I made a horrible choice here. Or why did this happen? So it can be really useful. For example, take a little booksy. You write down the investment choices that you made. And then every time when you look at your investments, look like, from, oh, why did I do this? Check if it's still right. And if you make mistakes, try to find out about them and write them down really. And I would actually say to people, try to really write it down by hand, because one of the advantages of doing that is you'll remember way better. It's proven in many studies, and keep that list. And when you, at some point you're making your new decisions or say like, oh, I've got a new investment plan, look at it. It's not the easiest thing to do because it's a big book of mistakes. And of course, nobody likes looking at a big book of mistakes, but it's one of the best ways to do it because otherwise you keep forgetting. There's also all kinds of ways to try and think better. If you look at a lot of the really successful investors like a Buffett, like a Munger, like all those exceptional people standing out, for example, they spend a lot of time reading, and they also spend a lot of time reading philosophy, reading about thinking models. And they say themselves, those are ways to try and think in a more structured and in a better way. You know, that's philosophy, all those kind of things are really good in ways to think better. Try to remodel your brain a bit. Look at it as sort of going to the gym with your brain. Um, a lot of people, I struggle with it myself. Sometimes I try it in the investment world, try to do meditation because it's not a magical solution, but it's a way to empty your mind, clear your thoughts, and try to change the way you think about stuff. Because a lot of investors keep on thinking and keep on thinking and keep on thinking. I've got this one meditation that I do sometimes. And what it teaches you is this: take all those thoughts you have in your head and learn to sort of let them flow by you, you know, because we are taught every idea we get, we have to check it. Like in the stock market, everything that happens, we have got to check it, we've got to react. And actually, in this meditation, they teach like, oh, it's not bad to have all these ideas, to have everything around you, but learn to just let them flow by you. And you've got to let sort of think of them of you're walking in the street and the whole time you're passing people, you've got to treat the ideas a bit of in a similar way. You can notice they're there, you can see their presence, but just let them flow by you a bit. And it does help, but it's not that easy. I'm certainly not a Zen Buddhist. You can ask my girlfriend; she would say the
Mm-hmm.
opposite. And also, I think it's another thing for a lot of people. Investing is a fun hobby, but that's what it should be. You know, you should also have some coping mechanism. Every great investor also has a hobby, does sports, that kind of things, way to clear your head. And one of the things I maybe believe in most of all is the wisdom of crowds. A lot of people start investing on their own, but the wisdom of crowds is the idea that a whole group of people can come to a better solution than just one person, because everybody's got a bit of knowledge, and if you bring it together, you create these bigger holes and these bigger ideas that are better, and the way of learning from each other. That's also what's really nice about VFB. We've got all these investment clubs we set up, and if you do that, you get people with all kinds from all kinds walk of lives, all kind of experiences. You get young people, old people, and you come to better ideas, and you help each other, you coach each other, you point out each other's mistakes. And that's just really interesting. It does require, you can't just put 10 people who are exactly the same together, because that happens sometimes. You get like 10 people with exactly the same age, the same background, and so on. Then you're going to get groupthink, you know? But if you put a really big group of different people, young people, old people, men, women together, they all think differently, and you'll get these new ideas. And it's fun to see in some investment groups, people are like, I have an investment idea, I doubt it, what are you thinking? And everybody starts thinking together and you get to these better ideas. I think it's one of the most beautiful things about FIRE Beer and about other groups is how you can create these little nuggets of wisdom together. It's really interesting to see. And sometimes the process is so interesting. You see someone coming with an idea and someone else answering. And before you know it, you get this whole dynamic. And that's also a really good one.
Interesting. Interesting. So you've just to recap a little bit what you were sharing here as
Mhm.
ways, like what things can help here, right? So
Yeah.
you said first is learning about behavioral finance and investment biases and reading
Yeah.
about them. You've written about this in the past, so maybe get
Yeah.
some of your past work. Repeat, repeat, repeat.
Like in
And
everything. Yeah.
like in everything, no practice. So basically be aware of things and then observe to see if you're, if it's happening to you.
Yeah.
And then write things down when you're investing
Document it.
because
Yeah.
that that helps basically see what was your expectation for a certain thing that you're doing
Mhm.
now and your goal and what you think is going to happen. And then whatever happens, go check back and see if it actually turned out that way. And if it didn't, why not? Because then you might be able to highlight, some of the
The
behavioral mistakes
mistakes.
that we've
Yeah.
highlighted before: overconfidence, self-attribution bias, and the illusion of control. And often it would be some of those, right?
Yeah.
And then you talk about like thinking better, so
Yeah.
learning from philosophers, meditation, etc. And then working with other people because yeah, other people can help you identify
Yeah.
those mistakes and identify
Mhm.
things that you wouldn't on your own because you're prone to your own biases. But
Yeah.
other people can say, hey, I think here you might be a little bit overconfident in this space,
Yeah.
right?
A
So that's quite interesting. Yeah, I love it.
really good one. It's not so much the crowd, but a really good one is if we look at Buffett and Munger. He was also saying this. Buffett always had ideas and this and that, and Munger, who was his right hand man, was a guy who went with his ideas, and he said like, "Oh, he was so good at picking my ideas apart and destroying them," sort of. And that's why they made such a good team. They were all constantly criticizing each other, trying to come to better ideas, to think better, to keep their emotions in check. It's such a wonderful idea. Like Buffett was coming up with all kinds of ideas, and Munger was like, "No, that's sometimes really saying that's stupid," that bluntly. But it's such a beautiful example of people interacting and looking at things in totally different ways and coming to better results.
Yeah, I think in investing it makes sense to ask for other people's opinions,
Mhm.
but not for other people's advice.
Yeah, yeah, and also not try to also talk to people who might have a totally different investment approach than you. Because if you only surround yourself with people who think exactly the same, they'll always be saying, "Oh, go ahead, supporting you." Try to find people who you actually really disagree with, get them to give you opinions. Because we're passive investors, but I also love talking to a lot of active investors because then they point out things that I was like, "Huh, I didn't think about that." Try to learn from the people you might really disagree with.
Yes, and talking about passive investors, how does, in your opinion, how does index investing, help with all
Mhm.
this?
Yeah, it's not like it's a magical cure. Those don't really exist in investing. That's too bad. But it will help with certain things. For example, it is kind of a modest way to invest if you think about it. You're not going to say, oh, out of the thousands of stocks, I'm going to find that one that outperformed. Instead of saying, I'm going to find the needle in the haystack, as they said, I'm just going to buy the whole haystack. So it's pretty modest when you think of it. It's not like, oh, I can do better than everyone. I'm just going to do the average, and be better by actually doing the average, which is kind of a funny thing. So you sort of, some people say you're settling on the market performance, but by doing that, by being modest and actually saying the average is good enough for me, you actually often outperform a lot of people.
Yeah, actually, a lot of
So
studies
it's,
show that on average, most investors underperform
mhm,
massively the market, right? One of the main
mhm.
issues with investing is that the investors don't get the returns of the market because of all sorts of
Yeah,
reasons, but obviously active management and emotional reaction to certain things, and then fees and costs. And index investing allows you to not fall that low, but basically settle for something that's more
mhm.
average, but is actually performing better than most
Yeah.
average investors, right? So,
Yeah, it's
um,
it's it's kind of a funny thing. People say, "Oh, I don't want to do index investing because nobody would sell a product saying this is a product for the most average people out there."
no,
Nobody likes that. Everyone's like, "Oh, this is for exceptional people," or everyone's like, "Oh, I gotta get me some of that." And
and
that's a funny
actually,
thing. You
it
get,
actually is. It
yeah,
actually is like that when you think about index investing. the average investor is an active investor at the moment in Belgium
Yeah.
specifically, right? And
Mm-hmm.
average investors are getting, I mean, when you look at the study like Dalbar, right, who does this
Mm-hmm.
quantitative analysis of investment
Yeah.
behavior study every year or so, and every year they look at, now they're looking at 30 years of data, and they see that the average investor is underperforming the market by 3 to 4% on average each year, right?
Mm-hmm.
And this is
Yeah.
huge. This is huge. And so
Yeah.
you could say, well, that's for average people. Active
Mm-hmm.
investing, bank funds, private banks,
Mm-hmm.
stock picking, that's what most people do. So the average is that. And then exceptional people get exceptional results, which is the market with market returns. And obviously,
Mm-hmm.
you can approximate market returns, right? You might still have some fees and there's ways of sort of improving performance, but market returns are essentially the exception at the moment. So you could,
Mm-hmm.
I think one way of branding index investing is saying this is investing for exceptionally evidence-driven, research-based
Yeah.
people,
Yeah.
which
And
which can help them.
yeah, it does have some other ways. The thing is, a lot of people do too much because they have that the illusion of control. They try to control everything. They overestimate themselves, and it's really easy if you think about you set up an ETF portfolio. It's really easy to make it really simple, first of all, and to automate it. I often show this image that says, if you want to be a better investor, invest sort of as like a robot. You set up a portfolio, you automate it like, for example, you say, I'm going to just follow a world index. You open up an account, you set up your bank account and say, every month I put in 500 euros, it's transferred automatically. A lot of brokers even often offer systems where they buy it automatically for you, so you don't have to do anything. That also makes it a lot easier. You don't have to put in that much work because essentially what you also learn from behavioral finance is that people are lazy. So the easier you make it, the better. And it also prevents, if you invest like that, like a robot, and you do it systematically, even in a good month, you'll buy more. In a bad month, you'll buy more. And you won't have that chance to think like, oh, the market is going up, I don't want to buy more. The market is going down, I'm panicking. You, with ETF investing, you can really automate all that process, make it as simple as possible. Market, done. And that's also a nice thing about ETF investing. I think a lot of people also struggle. After a while, investing becomes such a big thing and they put in so much time. And there's this thing like saying, I think it's from Latin somewhere, and they say like, money is a wonderful servant, but is an awful master. And it's true. You can just kind of automate your whole ETF process and do it in like 10 minutes a month. And you can just live for the rest and enjoy living. You invest to live and to live a nice life instead of living to invest, you know? Because I had a colleague of me, Stephanie, and she wrote that down, and a lot of people reacted to it and said, "Oh, I only have to spend 5 minutes on my investing every month." And a lot of people are like, "How dare you say that? And how is that possible?" And this and that. And she's like, "Yeah, but it's true. I mean, I do think about it a lot, and I have thought it all out. But I only have to spend 5 minutes on that, and for the rest, I can enjoy my life instead of having to constantly worry about the markets and so on." So it's a beautiful example. So it helps to optimize. It helps to be modest. It helps to reduce choices and so on. And there's all stuff that we suffer a bit from when we're actively investing. But of course, no miracle solution. Even passive investors often make mistakes. So you also have to accept that a bit, that you'll never be 100% rational, you know, because even you see that probably with a lot of ETF investors, you can make it as simple as possible, but still you've got a lot of people that keep tweaking it and overthinking it and constantly being like, oh, I should change this and that. Just nice thing about ETF investing is it really follows that one mantra, like keep it simple, stupid. And that's a nice thing.
So what kind of mistakes do you see ETF investors make? Because I think like this might be overconfidence showing in me right now, but I
Mm-hmm.
don't change anything in my portfolio. I don't do any market timing.
Mm-hmm.
I I basically don't touch anything, right? And I don't tweak anything. And that's how I teach it as well. It's super simple. There's two or
Mm-hmm.
three ETFs, one or two stock index funds and one bond fund, and an asset allocation that changes not based on
Mm-hmm.
market, but on my personal like needs or personal situation. And I just, everything is automated, and I don't do anything related to the market, right? I don't change anything. So I might be, I know I'm an extreme example in the sense that I've
Mm-hmm.
been in this world of index investing for so long that it's part of my life, right? And I depend on it, right? I leave 100% from my portfolio. I don't
Yeah.
Take money from any other source, right? That's my only income. I live from it 100%, and yet I don't touch it, right? When you say Stephanie spends 5 minutes a month, well, that's about the same for me. 2 times 30 minutes each year, right? So it's 1 hour per year.
Mm.
That's all it takes, and that's my entire life depends on it, right? But so obviously, I'm just one example of index investors. But do you see, like, how do you see those mistakes materialize with ETF or index investors?
Well, there's a few, like you say, a lot of people who keep tweaking their plan. And just to be honest, before I get a lot of emails or comments like this guy thinks he's better than everyone, I make a lot of mistakes too. I'm absolutely irrational in a lot of things.
So maybe
Uh,
tell us a bit about your mistakes or
yeah,
like
but
what you do,
I
right?
also noticed in the beginning, I was like, oh, I'll start investing and I'll invest worldwide. And I was like, oh, but you could add a little bit of this. Oh, and you could add a little bit of that. And if you tweak it, maybe you get a little bit more performance and so on. And the
Mhm.
fact is, at some point, you should just say, I've got a basic plan, a simple plan. I can do this for many years. That's good enough. For example, I see all these discussions. You've got like dozens of ETFs that track the world pretty much. And you keep seeing these discussions that go on for pages and pages. Just, but that one is a little bit better. Oh, those costs are a little lower. Oh, but you should maybe go for this one and all. I think that if you can get most people as far as to say, I'll invest every year, I'll put like a few €100 into a worldwide tracker, and I'll keep this up for years. Maybe that's good enough in the sense that, okay, maybe they could have used another ETF and they would have won like 3 basis points. And if you calculate that on a long while, it make a little difference. But the fact is, if you can get people to really do that, to put money into a nice, a good, decent ETF and keep doing that for many years, that's enough. It's like they say, the enemy of good plan is the idea of a perfect plan, you know? That's a mistake that I see a lot, just trying to change and change and change and change. Like sometimes good is good enough, we should accept that. And what you see now, and that's an evolution that I think is a bit more dangerous. The ETF world is becoming popular. Everybody knows about it. And you also see that a lot of professional investors have discovered it. So you get all these kind of, may I say it, crap products. You've got all these thematic ETFs. You've got all these silly ETFs that don't add anything. Like for example, in the US, it's insane what kind of ETFs you can get. I wrote an article about it. You can literally buy political ETFs. Like you can buy an ETF that says I'm a Republican and it only invests in Republican things, and you'll teach those woke idiots a lesson. And at the other end, the lefties can go, I'll teach those damn people something and how to be progressive, and I'll only invest in progressive companies. But it's bullshit because they just put anything in there. It doesn't add any value. And the market really doesn't care about your political choices or your preferences. You've got the craziest things. I mean, you even have like ETFs that focused on one town, like in the US, one city.
Really?
Because yeah, and the funniest thing is I looked into it, and apparently that city is they've got some interesting tax advantages and so on. So most of the companies that own that ETF are only there with like a mailbox to benefit from that. So it doesn't have any real link to it. And you've got so many ETFs coming out, and it's kind of like a colleague of me used to say it's not a candy store investing, and that's how it ends up. You've got these millions of ETFs, the silliest things you can think of, like political ETFs, investing in any kind of trend or fad. And I do see that a lot of people struggle with that because they're like, oh, but should I add a little bit of this and a little bit of this? And I think that just goes away from the idea of what passive investing is, going into all these kind of niches. And I think that's one that people should fight a bit and defend. I should be careful how you said, but a kind of a pure ETF philosophy, because of course all these asset managers have found out ETFs are popular. Let's make all kind of products, and you see that it ends up being like sort of the flavor of the month. Like, oh, AI is really interesting now. Oh, we should all buy an AI one. A few years ago, we saw the same one with weed and marijuana, and you had all these funny ETFs like high and so on. They basically bled out because everybody got out of them. And you've got then there was a time that space exploration was a big thing, and you got ETFs like UFO and that kind of thing. And yeah, you've got the craziest things. So that's one that we'll have to struggle with a bit in the coming years, I think, because all these people are like, oh, ETFs are popular. Most people don't make the difference between a standard classical passive ETF or these teams or even these active ETFs that are coming out everywhere. And most of these ETFs are much more expensive. Everybody flows in, but way too late because you can't time the market, and then everybody flows out and goes to the next fad. So I think that's going to be one that a lot of people are going to struggle with, this choice
Mhm.
overload that we'll be getting. And it's typically human because in every aspect of life, we've got so many opportunities now. I think that's going to be a big one that the passive investor will have to struggle with. Like, who are the true ETFs and who are the ones that we'll be using for the long term? And I also see, and it's interesting, a lot of people say I'm a passive investor, but everybody claims a certain philosophy. Like, I also know a lot of people who are real value investors and really good at it. And somebody I know talked a lot about these things. He says, yeah, even these big value investors in private, when you get to know them, something like, oh, should I not jump into this hype? Oh, or this kind of thing. We all have our fallacies there, you know? And you see it with a lot of passive investors. We're 100% passive. We'll keep this up. And when the market goes strong, it's not that difficult. It's, we're making money. But then, yeah, like when you have a bad year, like 22, you see a lot of people like, oh, maybe I should wait a bit now because the market's down a
Mhm.
bit. I'm going to stop investing for the moment. Oh, it's gone up quite a lot. Maybe I should time it a bit. So it's really difficult. It's one thing to say I'm a passive investor. It's one thing to say I'm a value investor. I'm a quality investor. We constantly have to struggle there a bit, and I think everybody will feel this struggle. That's why I always say it's good to invest a bit like the robots, but even passive investors, and you probably see that in the community, a lot of people will struggle with that,
Mhm.
because we're just human, we have our doubts and our fears.
Yeah, I think I relate with some of what you're saying there. Obviously, not the active investing part, but it's true that
Yeah.
even for index investors, the question of when to get in is like the current the current
Mm-hmm.
political environment is
Yeah.
such and such. Is it really a good time to get in, right? We have the war there, we have the crisis here, we have this is happening, this new thing there is disrupting the
Yeah.
markets. Is now a good time
Indeed.
to get in? And this is it's often a question for those who are getting started with investing, right? And less so for those who have been in it for years or decades,
Yeah.
because it's like, yeah, but once you realize that you can't get in and
Yeah.
out every time that there's something that you think might happen, so it comes with time, I would say, that part. But
Yeah.
it's true that getting in with the big sum is scary,
Mm-hmm.
so there's a bit of that, and there's several ways we deal with it, but typically just
Mm-hmm.
getting in some way is the only answer, starting investing. And then I also see, there are some people who say, yeah, I do believe in that specific part of the market, so I want to be involved. And I guess the ways to manage, I mean, to me, the way we manage those biases and small mistakes, like they're not huge mistakes, I think, as long as people keep a majority of portfolio in a
Mm-hmm.
simple and
Yeah.
diversified index fund.
You could perfectly say like 95% of my portfolio is really irrational. And you should sometimes also allow yourself to be irrational, because
Mhm.
it's maybe stupid to say, but a lot of the things that make us great as humans are irrational. Why do we love art? I mean, it's just a few lines. Why do we love literature? There's no rational reason, but those things make. Why do we love children? Why do we love each other? You can make that really rational and really cold.
Mhm.
But the fact is, those things are irrational and they make our life beautiful. But you could also say in investing, like 95% of my portfolio, I'll go fully rational. But I know this little active part in me. My colleague Tim Nesman always says it in Dutch. He always says like, in every passive investor, there's an active investor trying to break free. I
I
like the
don't
way
have that part.
I like the way it says it because we have all these emotions and we try to suppress
Yeah.
them. But you could say indeed like 95% I'll be rational. And you have this 5% in which I do some funny things and enjoy myself a bit. Why not? As long as you learn from it.
As long as you take notes and then
Yeah.
compare back to your main portfolio, and at some point you realize, oh, maybe it wasn't worth all the work and the stress. Bit like when you compare it with stock picking, no?
The thing you say also about the timing in the market and the fear for bad things happening, you always see that. I once had this beautiful list and it goes from I think 1900 till now. And on the left side, they put the returns of the S&P, and on the right side, all the things that happened, like, oh, First World War broke out, oh, this happened, oh, this happened, oh, Actually, I think the year where 68 or something, where Kennedy gets shot and like the world seemed like it was on fire, the world was going to end. And you see the market really doesn't care and it moves on. And that's one of those things that I struggle with myself and that you see so much is negativity bias. It's really interesting, but bad experience, negative things, they stay with us. You know, you can have a wonderful day, everything goes wonderful, you're out with your family, you're enjoying yourself, and then somebody cuts you off in traffic and almost kills you and like, oh, you idiot, and that stays with you somehow. And it's really stupid if you look at it. We let negative things really control our life. And if you look at it, and when you were a caveman and you were stupid enough to burn your hand, you're not going to do that a second time, you know? And it was really important in those days, you know. For example, if you learned like, oh, those things are poisonous, I'm not going to be so stupid to eat them again, you know? That's how people learned. The idiot who kept eating the poisonous mushrooms and so on, that's the guy whose line died out, luckily, you know? And it had a really useful function because the world was really dangerous and we needed to learn, you know? You needed to learn not to get trampled, not to get stabbed, not to get killed, all those kind of things. But in our modern world, it is not really a good thing because it's very exploitable. Many journalists, and I'm very critical of that, many newspapers, the only thing they do is sell negative news because it sells, you know? Someone once said that to me, and I found it a beautiful quote. It's like, it said, negativity is like porno, it just sells. And it's such a dangerous thing because it weighs on people, and it's, especially in the stock market, people are always thinking, oh, this is happening, that is happening, and the world is always ending. And the fact is, if you look back in history, the world was always ending, you know, since the day we came to this earth. And the fact is, you have to realize things. And that's why I also tell people, read really good books. Like you probably know the book Factfulness. And it does nothing else but show us how the world really is, because we have got such a negative idea of the world. And it just shows us lots and lots of statistics and constantly proves that actually, if you think about the world, it's slowly getting better all the time. Just to be clear, the things that are happening like in Ukraine, it's horrible. And I'm not saying it's not horrible, but if you look at it, if you go back in time, there's way less conflict, for example, than ever in history. But we focus on that one thing that's happening in Israel, in the Ukraine. But then if you go back, like our great grandparents and so on, they lived in a world where the entire world was at war, where millions of people died. So we do still have these conflicts, and it's terrible they're there. But if you look at it rationally, those things are diminishing. And with a lot of things, if we don't seem to realize that if you ask 10 people like questions about the world, like how is poverty evolving, how is war evolving, how is the economy evolving, all those sort of things, how is nature evolving and all. And actually, if you look at the facts, we're slowly getting better, and we're at most one of the most affluent and wealthy times of our lives in history. But we keep having this really negative perception, and it's so dangerous, especially while investing, because all the time I get the argument about, oh, and you're going to be ETF investing. And one guy said, like, yeah, what are you going to do at a stock crash? Well, stock crashes are bound to happen. They will come. Bad things will come in our life, but we have to expect them, be prepared for them, and that's it. You cannot control them. And this negativity, it's such a dangerous thing because it's everywhere, you know, in everything we do. And it's one of the biggest things we should probably overcome. It's like you say, you've got money and you've got such a fear of losing it, but just letting it sit there with inflation, you're losing it anyway. So that's such a big thing. And it's such a difficult message because I try to be positive, and then people are, you're just a naive idiot. And the funny thing is, you can bring a lot of evidence to those things, and that things are moving positively. And there's a lot of people doing that. Like, I love the work that, for example, Visual Capitalist is doing. They're constantly showing in very accessible ways that we're moving ahead. But the only thing that you have to do is when you're negative, it's just an emotion. You just have to say, no, 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 everything's bad, and you feel it. And on the other hand, if you want to convince people that things are positive, you have to come up with all this evidence. It's way harder. So that's such an important one. Try to really focus on the negativity bias and try to let go of that. And you probably see it all the time with people who start with you, like they probably always focus, but this and this and this and this could go wrong. Such a difficult thing to get over.
Yeah, and it's again part of our how we work, and for investing it doesn't help us so much. But it's I guess this is a fourth quite important
Yeah.
mistake or bias that people have to pay attention. So It's like a bonus bias that we're talking and we're covering. That's really good.
You have to accept the world is always going to end. That's it. Everybody's always going to think it's.
Yeah, look, bad things are going to happen. We just don't know when, but on average, history shows that it always goes up, right? And now it's different. This time is different. It's also been, it's been said already for a long time. So is it really different? It's different, but it keeps going up, right?
Because someone told me, like, yeah, and those ETF people, and it will always go up and always go up and this and that. But what if we reach a point where the stock market crashes and it all ends? If we reach that point, that means the entire economy has broken down, and probably means our society has broken down. So even if you're an active investor at that point, if all of society has broken down, we've got bigger issues in the stock market at that point,
Yeah.
You can always think like that, but that's why you can also link it to the overconfidence bias. Yeah, if we always keep thinking like that and don't have a little bit of overconfidence, nothing will ever happen, No major discovery would ever have been made. For example, in history, like someone like Columbus, if he thought like that and he didn't have massive overconfidence, he would have never discovered anything, So a bit of overconfidence might be sometimes needed to get over all this
In a
negativity.
measured way.
Yeah, in a measured way, not in a in a really dangerous way.
And so when we were preparing for this episode, you also listed a few, resources that can help people with all this.
Yeah. For example, there's a whole bunch of great investing podcasts. One that I always recommend in a way is the Investors Podcast. They've got thousands and thousands of podcasts on every possible subject, a lot about behavioral finance too. What is fun in their older episodes, they often also covered one particular book. And during an hour, a bit more, they really explained everything you need to know, which is, I think, a really good one for people who don't have all that time or don't want to do all the reading. That's a really good one. If you Google around a bit, you find other podcasts who are really great on it. For Dutch people, I always say also look at Beursbubble. That's a podcast by a couple of guys I know who do value investing, but who do amazing things on behavioral finance and really bring it in a really nice way. There's also a lot of good online courses. If you look, for example, on Coursera, where you can find all kinds of courses, you can find free courses on behavioral finance. There's also the Corporate Finance Institute. They have paid courses, but they've got a few free ones you can try. I think also have one on behavioral finance. I would also, and now I'm making some little announcement here again for VFB. It's one of the great places you can go to get help. There's no commercial logic behind what they do. They're not trying to sell product, but what VFB is mostly about is united small investors getting together and creating that wisdom of crowds, And a lot of people who set up all kinds of activities and say, what you get there is amazing because everybody's thinking together and trying to be better at thinking. So VFB is one of the places to go. And then, yeah, of course, like a lot of people who follow me or read my stuff know that I've got a bit of a book addiction. I didn't really have put a lot of structure into it. I just grabbed, usually my workspace is covered in books on the floor.
What book would you recommend?
I've got a few here, like, first of all, Misbehaving. That's a really good one for everyone by Thaler, who is one of the guys who really did exceptional research in behavioral finance. And what's a great part about it is he's also a really great storyteller. So he brings it in all kinds of stories. Really good book. For the people who want a bit of background also, it's also a really fun one because this one is not really known by Michael Lewis. A lot of people probably know
This is
Michael
the
Lewis.
Undoing Project, yeah?
Yeah, they probably know him from The Big Short and those kind of stories. It did wonderful books. And this is one about the founders of behavioral finance and their personal stories and all. I like it because if you want to have a bit of a broader insight, it's nice. And then we come to what, in my eyes, is one of the best and least known behavioral finance books. And you can tell how much I love it because these are all the things that I thought like, oh,
So
I have to check it out.
For those of you who are listening to the audio version,
I'll call it. So it's called Behavioral Finance: What Everybody Needs to Know. So it's not
by
really.
Kent Baker.
Yeah, and a bunch of other people. I'll send you the link and so on, so you can share that too.
No, we will include the link to all the books
Yeah.
and resources in the show notes and the description.
And this one is really cool. So it's really simple. Behavioral finance: What Everybody Should Know. It's not just a standard reading book. So it's more like a textbook. It's full of lists. Like what is first behavioral finance? What are biases? What are this and that? And they go over all of them. But it's really well written in the sense that they explain what it is, but they also try to offer all kinds of solutions, you know? So they say like, oh, this is the bias, but how can you kind of find a solution to it? And that's
Mhm.
something not a lot of investment books do. What's also brilliant about it, it's got every possible bias you can think of,
Mhm.
but also it's done by real scientists, so they put in a lot of footnotes. So often I've thought like, oh, this is kind of interesting, but it's really short in this book. And then you go in the back and you've got like at least 10 links to articles, to interviews, to websites, and it's a treasure trove. So for people who really want to know everything about behavioral finance or want to write an article or something like that, you can find everything you can think of. And it's got some of the most famous examples, but also all of these little fun facts, which I love. For example, how they say, if you look at the times the stock market is doing worse, you can see that in hospitals, a lot of more people, like in New York City, get into the hospitals with heart attack, with stress-related stuff and all, because brokers get really upset that way. That's like a brilliant one. And also like there's studies in there that try to make a link between how the weather is going and how investors react. And it's really
Mhm.
interesting because sometimes you have really moments that the sun is shining, everybody's happy, there's a heat wave, and how it even those kind of things kind of impact us. It's full of cool little fun facts. This is another one that's interesting. Richer, Wiser, Happier. A lot of people will know this one by William Green. It's not a pure behavioral finance book, but why I would he actually follows a lot of famous successful investors, talks to them and tries to figure out how they work. But it's a really interesting one because he kind of makes a portrait of how these people think, and so you can learn a lot from that too. And these are also the kind of people who are not afraid to say like, oh, these are my mistakes and so on. So it's not a straight behavioral finance book, but it does show the philosophy in a way that's really good investors think. And the last one I took up, they're all a bit random, but there's the ones I really love is this one. Investment mistakes that even smart investments make by my friend Larry Swedroe.
Yeah.
I think you might know him, Larry Swedroe.
Yeah,
He's
his
also
work on asset allocation. Yeah.
yeah, he's very famous in the US. His books are not that famous in Europe.
Mm.
But his book, Investment Mistakes Even Smart Investors Make, is really fun, I think, because it's not one fluid book. It's like 100 stupid things we do and 100 questions. He picks them apart, like this or this question that he hears a lot of from clients and so on. He says, like, okay, this is the problem people come to me with. This is a possible solution, and this is what you should avoid. And he also puts in a lot of graphs and a lot of info. So it's a really fun book because it's also kind of easy to read in little pieces, you know. And now and then I still go through it and like, huh, this is interesting. This is a fun little fact. So it's a diverse group of books, but it's just a few ones. And I don't think I've chosen the most famous ones, but sometimes it's also good to have some other ones in there, you know.
It's a good selection because it doesn't include famous books, and so it allows people to discover other stuff, especially if you find those really good compared to the famous ones. It's nice. It's really nice. Appreciate that.
Yeah, these are really practical books, most of them,
Yeah,
especially the investment mistakes is a really practical one. The one, the behavioral finance, what everybody needs to know, is a really practical one. But it's the kind of book you could go to and be like, I think I'm making a mistake here. You can really look it up and go for answers and find papers and stuff that really helps you.
awesome. Awesome. Thank you, Thomas. So where can people find you and your work? I mean, you've given us so much value here. I'm sure a lot of people will want to know more about you. And
Yeah, I think that the easiest way for people to reach out to me is to go to LinkedIn, where I post many of my thoughts. If I write articles, I often post them there so people can read them and find them. And also, it's the place people can go in and just send me a message if they want. They might not get a response immediately, but I will almost always respond to people. So feel
awesome.
free to reach out and ask questions or suggest things. And
We'll link your profile also in the show notes.
perfect.
Are you part of the FIRE Belgium Facebook group?
Yeah, I think so. I haven't been on there enough lately. Forget
But
about it a bit, but I come and have a look now and then.
okay. Look, if people have questions also for Thomas, feel free to ask on the FIRE Belgium Facebook group and thank him. And
Yeah,
I'll be happy to support as well. Awesome. Thomas, this has been a pleasure. It's been really insightful. I love the conversation. I think it's also useful for all the entire community to learn more about behavioral finance and the usual investment mistakes. Thanks again for this. Is there a
thanks for
final
having me.
final thought, maybe a final piece of wisdom you want to share?
No, I'd say to people, we should all accept that we make a bunch of mistakes and that we're irrational. And of course, nobody's perfect. Nobody will be perfect. That's a lesson you also have to keep in mind. But small little changes are so important in investment, and small little changes in your behavior can make such a big difference. So the main thing that I would say is work on that. And one of the best ways, I keep saying it, is really getting together as investors, forming communities, because that's an aspect a lot of people forget. Investing can also really be a social thing. So get together, work on things, and set things up together. It'll make me so much of a better investor, and you can do so much more together than all on your own. So yeah, that's the final thought I'd give. Get that wisdom of crowds going and enjoy it.
Awesome. Thank you so much, Thomas.
Thank you for
Speak to
having me.
you very soon. Cheers.
Thanks.